Tahir Badshaw is now with us. He's a market master today, Chief Investment Officer, Invesco Mutual Fund. Tahir, good to have you with us here. Thanks for your time. I think let's start. Let me preface my question with a global aspect, which is this is the week where we get the start of the Fed rate cutting cycle and probably a global easing cycle, right? We went from 0 to 5%, and now maybe we start the journey maybe a little lower, not all the way to 0. Hopefully not, but maybe 2-3%. What does it mean for Indian equities? And in this kind of a scenario, which sectors will do well? And just a condition, I mean, let's just assume for now that this easing is going to happen in a non-recessionary environment. So it's not very weak data which will necessitate these rate cuts. It'll be okay on that front. So in that context, here in India, which sectors stand to do the best? Go on, Tahir.
Yeah, like as you said, Prashant, we are more or less on the cusp of the long-awaited rate cutting cycle, and probably it will start this week in the US and probably will follow through in India as well. Hopefully, given our inflation data has also been kind of reasonably supportive. Now, up until now, we've had largely value-oriented sectors which are generally associated with the rising rate curve, rate cycle doing well, especially industrials, manufacturing. Infrastructure-related ideas, which have obviously performed well, and those probably continue to benefit from the fact that government policies are supportive and the growth cycle is still reasonably in place. Although valuations in there have moved up, perhaps ahead of fundamentals, at least on a shorter-term basis. What we are likely to now witness going forward as we enter into the rate cut cycle, phase, is probably the recovery in growth-oriented stocks, and not necessarily from the point of view of immediately earnings following through very strongly, but clearly here what we will see is valuations ticking up, which we normally do, especially for sectors such as technology or consumption, value retail. All these are probably parts of the market which have kind of somewhat languished, maybe have underperformed the market, and those are generally reasonably sensitive to a falling interest rate cycle. So I think that's what probably looks like happening. What we therefore might probably see is a confluence where both sides of the market perhaps might run together. That happens in the later parts of a strong market cycle where we see probably more broad-based performance. So value industrials, those parts continue to probably remain buoyant on the back of earnings visibility. On the other side, you probably see the growth-oriented pockets at least start responding to the rate cuts, and probably earnings therein follow up later.
Okay, Tahir, hi, great to have you on. So, the question is now, what do you do from here? Because the market keeps moving higher. And as Prashant used, we try to come up with new adjectives to describe it. Freight train, right? A freight train of domestic liquidity, which is a fast-moving one, hitting the market on a month-on-month basis.
It is an unstoppable freight.
Unstoppable freight train.
It used to be, I looked at the data, before the elections in June, it was around $2 billion a month.
Yeah.
It's now, on a regular, casual basis, it's $4 billion of money is coming in.
40,000 crores,
right?
Yeah.
So, so for people, those who are waiting on the sidelines, expecting a correction, every month you look at the data.
Yeah.
I think we start every month with about 1 lakh crores which mutual funds are sitting on, which they want to deploy.
Yeah.
So
actually, let's Tahir, I'll come to my sectoral questions later. Just come in on this issue of the money flow, and this seems to be an irreversible trend, right? This is not a cyclical, but a structural change, perhaps, that's been put in motion. So how do you deal with this? And, what are the cash levels that you're comfortable holding in terms of, additional deployment? And then therein the question as well, actually, that I was going to come to, that where are the opportunities now? There's some sector rotation happening. People are going back to FMCG, banks, IT. How are you navigating it?
Probably you said it. I think that is the best way to do things in such kind of a market. You don't really have a control on flows on both sides. This time around, we are probably not only seeing, obviously domestic liquidity has been strong all throughout, but I think the foreign money also has started to kind of gather momentum in the last some days, especially given that we are seeing, once again, India benefit out of the fact that the Chinese economy is not doing as well. And there is clearly a case for market reallocation, which is showing up in the intensity of the flows. So I think The good part, at least as far as we are concerned from a fund manager's perspective, is that the markets are broadening. There are relatively newer ideas which are coming into play, where we can probably see some incremental deployment. We have to be obviously cautious of valuations. Now this comes actually free, so we have to kind of balance out things out there. But at the same time, I think it's giving us a little bit of width in terms of operating portfolios. Not all of it, but a fair bit of it we can absorb liquidity in sectors which have probably underperformed or let's say, like as I said, some of these growth parts of the market which have not done as well. So you named a few: financials, technology, some of the other sections of the market, even banks for that matter. Private banks and public sector banks to some extent. All of these are places where we can probably absorb a little bit of further liquidity that we are seeing into our funds. So I think at a portfolio level, the strategy is to essentially just follow a barbell approach. You do continue with some of the higher growth pockets of the market, which currently have earnings momentum on this side. At certain points in time when you see corrections. For example, we've seen some correction in some of the PSU names, especially on the industrial side, the defense side. Maybe incrementally, those are places where we might probably want to, start exploring. We were a little cautious some time back, given those hefty valuations which were there out there. Not that they've become very cheap, but clearly they are providing certain attractive entry points once again. So I think that's so by rotation, I think the market does keep giving you opportunities, and some of the newer stuff which comes through IPOs, etc., is also, and newer ideas which are emerging from the old set also is providing that extra width for us to operate.
Okay, all right. Hi, Tahir. Good morning. Hi. And good to see you. When talking about some underperformers, two private sector banks, they have been the big underperformers: HDFC Bank and Kotak Mahindra Bank, trading at around 2 times price to book, roughly. Underperformed. Valuations are still pretty much okay. And if the FIs are going to be showing us some money, then it could be allocated to some of these banking and financial names. Give and take everything, would you prefer some of these large private sector banks in comparison to the PSUs and other parts? If you look at the financials as well, we're going to have a new listing which probably could list at around 4.5 to 5 times the housing finance company, Bajaj. Your view on both these two names in particular, HDFC Bank and Kotak Mahindra Bank?
So without getting into specific names, but Nigel, it is difficult for us as investment managers to actually do anything on the basis of flows, whether they're going to come, not come. I think that is not the premise on the basis of which we can work. Yes, obviously, if that is something which is a latent proposition, maybe it might probably turn out. But we have to essentially work our way up in terms of where do we see value. And I think clearly this space has been value for a very long period of time. We still see the possibility of book value compounding in some of these names anywhere between 10 and 13, 10 and 15 odd %. And I think they are at valuations which are not very demanding for sure. So if you're looking at that rate of compounding, then these are clearly opportunities at this stage. But obviously the market to some extent is spoiled by the fact that we are seeing very strong returns in other pockets of the market, which are strong not only by quantum, but even in terms of the time frame in which those returns are achieved. So I think we have to be patient with some of these, some of the macro elements which is holding some of these sectors back. Banks, for example, be it deposit liquidity or probably be it in terms of compression of NIMs. I think as they start reversing, or probably even some of the regulatory harshness which we have probably seen in some time. I think if it starts to kind of reverse, that will draw excitement. I think of the last some days when we've seen foreign flows. To your question, I think we have seen that momentum come back into some of the larger cap names, not only the large private sector and banks, but even some of the other parts of the market. One day, I think I saw almost every stock in the Nifty being in the green. So those are typically places where we would expect probably foreign flows to dominate.
Okay, all right, got it. Tahir, I wanted your view on the other space, the aviation pack. There's only one way to play it, Interglobe Aviation. They've been increasing their market share. You have a tailwind because ATF prices are down by close to 5%. And we're getting into the seasonally stronger period, which is the second half of the year. The stock has already run up considerably. Now, suddenly there's hope that maybe the other player will survive. That's SpiceJet, which is a risky one because they've been losing market share as it is. What's your view on this theme? Stick to the leader?
Well, I think obviously this is another sector which has been developing or benefiting out of tailwinds, both on account of traffic, on account of the fact that physical infrastructure supporting air traffic is getting better. I think some of the issues which were related to aircrafts, etc., has also kind of been resolved. And last but not the least, obviously, oil prices the way they've been trending, and probably they look like remaining in a soft zone for some time. So I think demand as well as supply is starting to kind of become favorable. And while of course this this sector has been dominated by one large player holding a very large market share, but I think some of the other players also have their own niches. They have been constrained by a few factors of their own, which as and when they are resolved, I think they can probably also start benefiting out of some of the structural tailwinds which the sector is enjoying. So I think it's in the interest of the consumer as well that we have a few strong airline organizations operating in the country, and especially at the current stage of the India aviation cycle, where we are probably going to see demand being reasonably strong. So it's a good time. Probably we are still a reasonably consolidated industry in this segment with probably about 3 or 4 odd players operating. So I think there is probably some room for growth for different players, especially if they don't intervene on each other's space or each other's territory.
Okay, well, we hope that we do have a bustling aviation sector, and also for the sake of all the flyers and the passengers out there, that we quickly get more capacity addition in. Tahir, it's been a pleasure speaking with you this morning. Thank you so much for joining in, and we look forward to the next conversation as well. That's a word from Tahir Badshah.